up ahead. Affirmative 612.
Back for another edition of the Wealthy Pilots Podcast. Scott Osborn and myself here, your host, Mark Killian, to talk about demystifying, Scott, the Backdoor Roth. It sounds kind of shady, sounds kind of shifty, totally legal, totally above board. Yeah. But let's demystify that a little bit, brother. How you doing this week?
Great, man. It's the sun is shining. We got above freezing for the first time in 6 weeks, so it's incredible up here.
Gotta like that. Yeah, yes. Exactly. Yeah, we at the time we're taping, I think one of the coldest winters down here in the last 10 years. So it's a little warmer today. So I will take it.
This is our fourth coldest since 1941 up here in Ohio.
Yeah, exactly. So let's just move on into the warmer stuff for sure.
For sure.
But let's talk about this thing. Let's demystify this joker a little bit because again, it does kind of have that Backdoor Roth. Kind of has a weird little connotation to it, right? So I guess let's just start with the setup. Help break it down a little bit for us.
It's not like a huge annual, strategic unlock, so to speak. I think that's like a misconception because, the contribution limit is not that high of how much you can put in it. So I think it's something that just doesn't seem like a big priority. But I think something that our folks potentially, or not our folks because they're doing them, but folks out there might be a little bit missing the boat on is just the power of a little bit of investing and compounding over time and what that can really do for you. And so, to me, it just not only the Backdoor Roth, but even more importantly, just IRA contributions in general. It's just good to know even for your kids if you need to teach them and help them out too. But, ultimately, the IRS allows us outside of the 401k. The 401k is an employer-sponsored retirement plan. That's under one code of the IRS code. The code number and letter is the 401k. That's where that comes from.
Exactly.
And so separate from that, the IRS lays out the rules around individual retirement accounts, also known as IRAs.
Right.
So when you're, they get into some complexity on income limits, contribution limits. So income limit is basically, hey, at a certain level of income, obviously the easy planning number is right around $200,000 because there's like phase out limits and all that. So again, you can get into more detail to see all the phase out limits, and the CPAs, help button that up every single year. But the easy number is like, okay, right around $200,000 a year for a single family filing jointly is when they hit the income limit and can no longer contribute, make a deductible contribution to an IRA. And so what that means is I can contribute to an IRA. I just can't get the deduction on it to reduce by my taxable income by that contribution amount. So for 2026, as an example, since we're recording this in 2026, the contribution limit is $7,500 a year or $8,600 for those in the 15 over crowd. And again, that's to a traditional IRA. If you're over the income limit, which I just double checked it's a little higher now. It's up to $230,000 is where the phase out starts for married filing jointly. And so if you're at that phase out level, then you can make a non-deductible contribution, which means I can put it in. It's not going to reduce my taxable income. Gotcha. However, it gets to be a little bit messy inside of that traditional IRA where you have some money in there that is deductible money and then some that is non-deductible money. So if you were ever going to do that, which I would not ever recommend, but if you were ever going to do that, I would typically separate those into two separate accounts because we run into, in our retired years, a potential tax nightmare where you have, through the distribution of those, you have what's called the pro rata rule. Which
I was going to ask you if that's where people trip up or not. So, yeah.
So if I have 20%, let's say I have $1 million and I got 20% in there that is non-deductible, 80% in there that's deductible. When I take a distribution out of that IRA, I have to take 20% of it as non-deductible, meaning I'm only paying taxes on the gains, and then 80% out as deductible. And when I'm pulling that out, I got to pay taxes on all of it. It gets to be a mess. And so we don't recommend that. And just try to keep it clean. So when you're in retirement, you're distributing things that are easy to keep track of, easy to pay taxes on, et cetera. So that's kind of one point I would tuck away on the traditional IRA side specifically. Now, if you're over that income limit and you're no longer able to make a Roth IRA contribution or able to make a deductible traditional IRA contribution, what a lot of folks will do, and we highly recommend, is we do these backdoor Roths. And it seems shady because it's, a thief comes in through the back door.
Yeah. It's a hilarious term when you think about it, but yeah.
Yeah. And I think that's a little bit of the turnoff for folks like, I don't want to mess with that. But it's not overly complicated at all. It's quite simple. If all you have is your 401k right now, it's very easy. We need to open an individual or a joint account. We're going to open an IRA with a zero balance on it. And then we're going to open a Roth IRA, probably also with a zero balance. And then we take money from either your checking account or your individual account. We put it into that IRA, and then you let the cash settle in that account. And the very next day you convert it, and then you're off and running in the Roth IRA, and you invest it in the Roth and let it move over there and grow over there. And the whole purpose of that is because I'm putting after-tax dollars into the IRA because it's a non-deductible contribution, right? I pay the taxes on it from my payroll. It's sitting in my checking account. That money's already been taxed. If it's in my checking account, it's been taxed. When I put it into a traditional IRA and do a traditional deductible IRA contribution, when that money goes in there, it's almost like the IRS is giving me tax money back, right? That's the benefit to that.
Gotcha.
If we make too much money, they're not going to let us have that tax efficiency. So we're going to put that after-tax, non-deductible contribution into that IRA. The very next day, we're going to convert it. Since there's been no growth on that cash, we don't owe any taxes on the growth because there hasn't been any growth. And then we convert it over to Roth. We're doing a non-deductible contribution followed by a conversion. And when we convert it, no taxes are due. It goes over in the Roth. It invests over there and grows over there. And again, it's not a huge dollar amount. If folks are used to maxing their 401k and they're between them and their employer, they're getting somewhere between $70,000 and $85,000 into the 401k. To be able to contribute $8,600 feels like it's not really that powerful. But if you're doing it for you and your spouse, it's $17,200. And then if we do that for 20 years and get good returns, it's $1 million. And so, by implementing this little habit, and again, that's for somebody in the middle of their career.
Right.
But I recommend it for anybody. Hey, if we don't have a large IRA balance that we got to work around, this is low hanging fruit to start building Roth dollars in your plan. And again, a lot of our folks, when they end up with extra cash flow, and it's happened quick, Mark, over the last handful of years between, just airline pilot pay growing and then kind of coming back from the pandemic. And it's happened fast where a lot of these folks are in the amount of retirements they've been able to upgrade and raise in seniority and new contracts where they're like, man, I'm up a couple tax brackets and I still got excess cash flow I never used to have.
Yeah.
So you want to be conscious of like, let's make sure we get that to work, right? We don't want to just, stick it in a bank account where it's doing nothing or have it there and it just gets spent because it's there. So this is like an easy strategy that we should definitely be trying to implement as soon as possible. The reason I like to bring it up every February is because we do have we have a deadline to implement this for the previous year.
Oh, yeah.
It is tied to the IRS does give us a little bit of time in the winter and early spring to get this taken care of, where we have until the tax line April 15th to do this every single year. But I implore you, get it done. It's very, very easy. And in fact, we'll include this in the email when we shoot this out to everybody. They should be ask us for help. We will help you get it done. It's very easy it takes an hour. And in 1 hour, we get the whole system set up to get this moving for you where it's on autopilot moving forward. It's very, very easy. And it's an easy way that, hey, if I got a little bit of extra money a year, what are we talking? $1,400 a month. If I got a little bit of extra money throughout the year, I could pull this lever on and set myself up to have potentially a 7-figure Roth IRA when I retire. And I probably didn't even notice the money was missing. Well, you're going to notice when you got a 7-figure Roth IRA in retirement, I assure you.
Yeah, for sure.
So this is one of the ones that we recommend again, and you might have an old $3,000 IRA or something like that that's out there. We might have a little cleanup to do where we need to convert some of that stuff and what have you. But man, I'm telling you, it's an easy strategy to get to work and put a little bit of that money to work. And then again, we got the tax deadline coming up to get us caught up for 2025. And then you can kind of just keep it moving forward year over year from here.
Is it worth it to mention to folks the differences between the mega backdoor Roth? Because that's a term they might see as well.
Yeah, the mega backdoor is interesting too. And that's something that typically we can do inside of the 401k. And a lot of times that will come if somebody has after-tax dollars in their 401k, because the 401k has the same three classifications of money, right? They got after-tax dollars, which basically means it gets funded. The excess amount above your standard employee contribution gets funded.
Yeah.
And then it has a sub account in the 401k and it can sit there, and then it grows, and you'll owe taxes on the gain, not the cost basis. But what a lot of these plans allow you to do is they take those after-tax dollars and then they convert those to Roth as well. And
Gotcha.
So, and again, there might not be, if you do it right away, like if you're on top of it with your contributions, it's not taxable typically. But also, if you happen to do it and you have a large gain on that cost basis, then yeah, you'll owe a little taxes on that. But again, that's inside of the 401k. And so we want to be a little conscious, I guess, of
right.
how much converting you're doing and what the taxes are. Cause you can call Schwab or Fidelity and they'll do that for you. And then, you might get a surprise later when you get a 1099, you're like, oh shoot, I didn't know I owed taxes on that. But yeah, the mega backdoor though is what's great about the conversions here, Mark. There's no limit on conversions. Again, this backdoor Roth, there is a conversion involved there, but it's limited every year based off of the contribution amount that we were able to do previously. Okay. Meaning the 7,500 or the 8,600 that we're contributing to that IRA with that non-deductible contribution.
Yeah.
That's kind of our ceiling on the annual backdoor Roth. It's limited on the top side by that non-deductible contribution amount of 7,500 or 8,600. And if you got a bunch of after-tax dollars in your 401k, there's no limit on conversions. So you can aggressively start to move money over into the Roth as well inside of the 401k.
Yeah. So, for a lot of people checking this out or whatever, it's a totally used strategy on a regular basis. So it's just certainly, it's just a workaround that's totally part of the tax code. So nothing nefarious. If you got questions on, is it right for you, how to get involved or how to kind of work with your advisor on and doing some of these things, and you need some help, reach out to Scott. Go to retireairlines.com, have a conversation, retireairlines.com, get some time on the calendar, have a chat with him. We'll have links in the show descriptions here below on YouTube. And don't forget to subscribe to us on YouTube as well. Apple, Spotify, and of course, right here on YouTube, that thumbs up, notification bell, all that good stuff. All right, my friend, anything else?
No, that's it. Like I said, this is low hanging fruit. This is something we should be getting done soon. And if you need help, reach out. This is a very easy one we can knock out in 1 hour, get it on autopilot for you moving forward, and then see if you want to talk about anything else. But this is an easy one to get done.
There you go. That's why he's the airline advisor. So click on the links, get started, have a conversation, subscribe, and we'll see you next time here on the Wealthy Pilots Podcast with Scott Osborn.
Hey everyone, real quick, if you haven't grabbed Scott's Financial Flight Control Toolkit yet, now is the time. This is packed with tons of helpful resources and tools like this, Scott's book, The Dichotomy of Wealth, which is a pilot's guide to maximizing wealth and cash flow in retirement. You also get access to some great guides like this one, Advice Matters, which breaks down 4 key ways a good financial advisor can help you boost your returns over time. And guides like this one on the pitfalls of emotions when it comes to investing, and this one on the HCM byline investment strategy, and more. So if you'd like your very own Financial Flight Control Toolkit, just click the link in today's show description, and Scott and the team will be happy to get one sent your way at absolutely no cost to you.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.